Welcome back, everyone. It's that time we've all been waiting for. We have 25 super investors that we're going to be ranking on a super investor tier ranking. Overall, how good they are, meaning how good their track record is, what their investing philosophy is, how proven it's been over long periods of time, how good of teachers they are, how consistent they are, and just all around, I'm going to combine all of those factors together and rank them overall. So this is going to be the super investor tier ranking video. Let's go ahead and jump right in. Now let's go ahead and start off with Warren Buffett. This one is obviously going to be an S tier. And this should be obvious. If you're arguing with this or you're confused of why Warren Buffett's S tier, then you need to read a little bit more about him and study his background. Buffett has a compound annual growth rate of 20% for over 40 years. That in and of itself should be S tier. No one else has done it. Literally no one else on planet Earth has that track record. It is unbroken. There's people that have done better for a shorter amount of time, but quickly their gains flatten out. They start to go down after 10 years or 15 years. Having 40 years of 20% returns is very difficult, especially at this scale that Buffett has grown to. If we open up Berkshire's annual report here, one of the things we can look at, and this is one of the first things on the list, is their returns. They show it right up front, and the S&P 500 is what everyone, literally every money manager compares themselves to ultimately. It's the index to beat. The gain for Berkshire is 3,787,000%. The gain for the index, the S&P 500 over the same time period, is 24,000%. It's astronomical, the amount that he's beat the index over this time period. And perhaps what Buffett has been so good at for such a long period of time is never going through devastating circumstances. He's always protected the downside of his investors. He never once put his investors in jeopardy throughout his entire history. So we have Warren Buffett there on S tier. Let's go ahead and move on. Next up, we have Terry Smith. He's one of my favorite investors. I think that Terry Smith is a fantastic speaker, an orator. He can go in front of a stage and really, he's just funny. He's entertaining to watch, and he's also a great investment teacher. Now, his returns have also been great. Terry Smith runs the Fundsmith portfolio. Fundsmith right now has had an annualized compound annual growth rate of 15.6%. With how good of a teacher he is and his returns, I think Terry Smith belongs in A tier. Now, next up, we have Chamath Palihapitiya. He's not necessarily a super investor, but Chamath is notable in the investing community because of his very popular podcast, the All In podcast, and because of his involvement in a lot of different companies called SPACs. Now, if we look at Chamath's history in investing, we can look at the SPACs and their returns since he pumped them and advertised for them and said how they're going to change the world and become worth so much more than other companies. They're down around 90% from their all-time highs, and they're down across the board around 75% from the beginning. We have Space as one of them. This company has been a disaster. And then we have other companies like Clover, another one that Chamath SPACed and advertised. He received promotional fees for saying how great this company was, and it's down 80% since 2020. Chamath has a history of saying that he's very bullish on companies and then later selling out of the positions without letting the public know. He did this with Tesla. He said that Tesla's the type of company that you buy into, you hold on to because you want to be aligned with Elon and invested with Elon. And then later in a CNBC interview, he acknowledged that he had sold out of his entire position. So he's routinely doing this type of thing where he kind of says one thing to the audience and he speaks very positively about companies. Then the next thing you know, he won't have any ownership in that company. Chamath also has a long history of making bad predictions. He said a couple years ago that one of the easiest shorts in the market is banks. Banks have gone up since then, and the companies he thought would do well haven't really done that well. But out of all the things that Chamath has struggled with, I think all the blunders he's had throughout his history, possibly the biggest one has been his comparison of his portfolio of social capital against Berkshire. In his annual letter of Social Capital, which is his portfolio, that's his company there, this is during the 2021 bubble of all of these SPACs and growth companies, he had the gall to compare his performance to Berkshire Hathaway's, to put them side by side and suggest that he's better than Buffett. And out of all the dumb things he's done, that has to be the dumbest. Comparing yourself to Buffett is a losing game. Sure, he might be able to beat Buffett on a one-year basis like he did in 2021, but the very next year, social capital and all of those investments started going down. So what did he leave off of this report the very next year? He left off the comparison to Berkshire Hathaway, and he also tried to make these reports much more private. For Chamath, I rank him as F tier. And out of all the things that I think he can complain about with Chamath, maybe his politics, maybe his takes on different subjects, people can disagree, and that's fine. But out of everything that he's done, I think the biggest problem is people like Warren Buffett look out for their shareholder. They protect their shareholder. It means everything to him that his shareholder is taken care of. And I don't see that type of regard at all with Chamath. I see just the opposite. Now, next up, we have Bill Ackman, who is an investor that I like. I don't agree with everything he says. He has lots of opinions he shares on Twitter and different things, but the results speak for themselves. Ackman's Pershing Square Capital, which is his hedge fund, has had market-beating returns for a long period of time. Now, it did go through a period of immense struggle around 2014. They really had some bets that went the wrong way. So he's revamped his strategy. He's focused on long positions. He's not doing more of the activist going against the grain and trying to butt heads with different companies. He's trying to find great compounders, hold them for a long period of time. His returns since the beginning have been 15.4%, which have been very good returns over that period of time, beating out the S&P 500. And I think he shares valuable information. I like looking at his research on different companies. I like scanning his portfolio for potential ideas. For me, Bill Ackman is A tier, right up there with Terry Smith. Now, next we have Chase Coleman with Tiger Global. This is one of the portfolio managers who was known to be an outperformer. And since the Fed kept interest rates low for such a long period of time, over the past 20 years, he had substantial outperformance by investing in very high beta, high growth companies. Ones where the fundamentals were a little iffy, but overall they were very aggressive companies. And Chase Coleman became notable for being this investor that was continually just crushing the market. But overall, it was a poor portfolio construction because it didn't properly take into account different factors in macroeconomics. Tiger Global's fund went down 50% during a year where the market only dropped 16%. So massive, massive losses in a single year. This one year wiped away all of the alpha for the entire decade. So all of those excess gains were gone. And this type of event actually is common amongst poorly constructed investment strategies. See, the strategy being poorly constructed means that it will work really well in only one type of environment. If we have a low interest rate bull market with lots of government intervention, that's when Tiger Global did really well. But as Warren Buffett says, as the tides go out, you get to see who was swimming naked. In this case, Tiger Global and Chase Coleman, they're the ones being exposed here. The fund dropping 50% shows that they weren't looking at different environments. So when I look at this overall portfolio strategy, I don't think it's a good one. I don't like strategies that only work in certain conditions. And I'm going to put Chase Coleman down here as a D. In my opinion, I would never invest in a fund that has the risk of going down 50+% when the rest of the market's only down 10 or 15%. That's just way too risky, and you stand to lose tremendous amounts of returns over a long period of time due to this poor construction of a portfolio. Now, next up, we have Howard Marks. And Howard Marks is a little bit of a mixed bag here. He's not necessarily at the stage where he's going in and managing a portfolio directly, picking out 10 or 15 companies and doing deep dive analysis on them. He's more of an investing philosopher. He authors books, he authors memos, he writes about investing, and I really enjoy reading his thoughts and listening to his thoughts about investing. So I'm going to go ahead and put him as a B. I think that he's a great teacher. You can learn a lot from him, but I don't think you're going to be getting any type of investment ideas from him on specific companies. Now, next we have Dev Kantesaria, who is an investor that I believe is one of the few of truly elite investors that has a well thought out, disciplined strategy and does research on companies that I think is far more advanced, in-depth, well-researched analysis than most investors, including most super investors. He runs a concentrated portfolio of very high-quality monopolistic companies that he really does deep dives in. He learns the companies in depth. He analyzes when they're going to be able to increase prices, what products they'll deploy, and then he allocates a tremendous amount of capital into a single company. The run-up in FICO has been phenomenal, and his early investment in that, realizing the outcome of that before the market did, is just incredible. It's really one-of-a-kind type of investor here. Dev Kantesaria is one of the few that I think deserves to sit in S tier currently. Now, I still think that he's not as good as Buffett, so there is some nuance in this tier and S tier, but he's one of the few that I think could take the mantle from Buffett and carry it on. Carry on value investing, carry on qualitative research. I think he makes overall the art of investing and individual investors look good. He's not a closet indexer. He's not just buying companies and charging fees. He really knows his stuff. Now, next up, we have Mohnish Pabrai, who is a super investor that's more commonly known online. So he has a little bit more popularity. Recently, Mohnish has come under a bit of criticism for leveraging his relationship with Charlie Munger. He purchased one of the charity luncheons with Buffett. He met Charlie Munger that way. They've since become friends, and he talks about his friendship a lot. He talks about different conversations they have. Some people have said that this is just clout chasing, or he's trying to become popular by virtue of knowing Charlie Munger. I don't think it's so bad. In my opinion, if I was friends with Charlie Munger, that's something I would want to talk about as well. I think that's pretty cool. But overall, when I look at Mohnish and I try to rank him amongst other investors, I like him as a teacher, and I like the concepts that he explains. I enjoy his YouTube videos, but I think that his portfolio is not the way that I'd run a portfolio. It's a little bit haphazard. He changes positions, and he seems to change investing philosophy from time to time. I think it's difficult to follow, and his returns have been unknown. He hasn't been showing his returns recently. For that reason, I bump him down to B tier, right along with Howard Marks, and I think that they both are similar in that regard. Now, next up, we have Chuck Aquary with Aquary Capital Management. There's also some other investors there, like John Neff, that I think are fantastic portfolio managers. I'm going to put him up in S tier. I think that Aquary has a long enough history to prove that he is an S tier investor. He's very transparent. He protects his investors' capital. He has a great deal of analysis on the companies. And I think that he invests very Buffett-esque. He just holds companies very long-term. He tries to buy them at reasonable prices, and he's had fantastic returns. So he's one of the few that I think belongs up there with Dev Kantesaria and with Warren Buffett. Now, next up, we have Cathie Wood with ARK Innovation ETF. She's had a history of underperformance, high volatility, poor portfolio construction. She said that her ETF is an innovation ETF. Innovation's in the name, but she doesn't hold what are the most innovative companies like Amazon, Apple, Nvidia, Google, all of the big tech companies that are really making new innovations. Instead, her portfolio holds companies like you have Roku, you have companies like DraftKings, you have companies not coming out with hardly any innovations. So she has a different strategy than what she names. She's not protecting investors. She charges very high asset management fees while bashing indexes. And she specifically targeted retail investors. Because of the combination of all the things that she's done to enrich herself while giving investors a lot of underperformance, and the majority of them have lost money in her fund, I believe she belongs in F tier. Now, next up, we have Pat Dorsey, who is the Morningstar moat guy. He's been running his own fund, his own portfolio. I don't like the investing strategy. It doesn't make sense how he goes about it. I think there's a lot of trading, a lot of investing in companies that don't have strong moats. And from what I can gather, his returns have not been that public nor that good. For that reason, I put him down into C tier. Now, next up, we have Michael Burry, who obviously has a lot of controversy around him. He's always someone that's a bit of a mixed bag. Early on in his career, he had a lot of success. From 2000 to 2006, he had 100% returns, while the market had no returns. So he really crushed the market over that time period. Then in 2007, of course, he had his big public bet against the market. He was played by Christian Bale in The Big Short. That made him very famous and a controversial figure. But more recently, I think he's been damaging his reputation by making these tweets and these little predictions that have not gone his way. For example, he tweeted out, "sell," just one word, a year ago. And that was an outstandingly wrong prediction. And he's made a couple of these very wrong predictions over the past couple of years, which I do believe has hurt his reputation a little bit. I'm going to put Michael Burry in A tier. I think he's very good, but because of how crazy his strategy is, how frequently he trades, and because of the many wrong predictions he's tweeted out, he's not at S tier. Now we have Nelson Peltz, who is an activist investor. Almost every investment he makes, he takes an active role in. Like Disney, for example. He came into Disney, he offered his advice and criticism for the board. Disney went up to $115 at the time, and so investors had that opportunity to take gains at that point. But Nelson Peltz also has not had significant long-term outperformance. And for that reason, I'm going to put him down here with Pat Dorsey at a C. When I try to get his returns, it's very difficult to find, but most of the data shows he's just not having great success compared to the index. Now, next up, we have Dave Portnoy. He's not a super investor, but he's someone that I wanted to throw into this list because Dave Portnoy is entertaining. And he has had video montages of him doing day trading on YouTube and different things. And he's not good. He's buying companies for no reason and then selling them for no reason. But I'm not going to rank him F tier because the people in F tier, I believe, have actively hurt other investors. They've caused losses with other investors because they looped the capital of other investors into their investments. With Dave Portnoy, he's simply just doing his own thing. He's not really wrapping other people into his investments. He's not SPACing companies. He didn't create an ETF where he charges high fees. He's just trading with his own money. For that reason, I think he's a step above F tier. Now we have Stanley Druckenmiller, who is someone that he has a record that's difficult to compete with. It's one of those ones that comes really close to Buffett. 30 years of no losses and annualized returns exceeding 30%. The numbers are astounding. Now, he's a trader, and a lot of people that say, you basically can't follow what he's doing. It's just too complex, and trying to follow his trades is near impossible. And there's also a quote that I really love from Druckenmiller. He says, if you go down 50%, you have to go up 100% just to get back to even. I've always thought the way to build a long-term track record is when you really see the ball, swing really big. And when you don't see the ball, don't swing. You can build a record when in terrible years you're up 0 to 5%, and then you throw a couple of 50 to 60% and the numbers look pretty good over time. So basically all he does is if he sees an attractive buy, he really swings big. If there's nothing that he sees as a really attractive buy, he doesn't want to own anything so that he can minimize losses. For most people, this is not going to work, but for Druckenmiller, it's worked outstandingly well. And I don't know how he does it. He just keeps this up for years. One of the most significant bets he made years ago was Nvidia. And this is one that I think it's very hard to see the valuation of it and to get behind Nvidia. But Druckenmiller did it. He saw it was an obvious play. He's going to make a lot of money. He swung really big into Nvidia. And of course, we know how that's turning out for him. When I look at where Druckenmiller should be, I think he's deserved the right to be at S tier. Now, where he lacks, I think, is in educational value. I don't think there's much that I can learn from him because I don't think I'm going to be able to replicate his strategy. But just with the returns and his level of excellence and the way that he's able to make money in almost any market, it puts him right there in S tier. Now, of course, we have Carl Icahn, someone that I think is a mixed bag. I'm going to be placing him in C. Carl Icahn has done some good things and he's done some really bad things. He's considered by a lot of people to be a corporate rater, to not really be helping out people in general, to simply be rating the value of different companies for short-term profits. He did that with Blockbuster. He was part of the reason that Netflix actually outcompeted Blockbuster. And he's also been involved on the wrong side of the bet. I didn't like that he helped out Herbalife, a company that I think is predatory in the way that it spreads. He bet against Bill Ackman, and although he won that battle, I think he won the wrong battle. I also think that Icahn Enterprises and the accusations against it are largely correct. So he has his own company that he bolsters up in different ways. It's highly dilutive. I don't think it's overall a good company. So I don't think that he's neither all bad nor all good. I put him right there in the middle. We have Christopher Bloomstrand, who is someone that I follow on Twitter. I like seeing his tweet storms or whatever we call them now on X. And he's a great teacher. I think he's a great investor. His returns have been a little bit flat. They've been around the market average for the past 10 years. Preceding that, he outperformed SPY a little bit. I think he's overall great, but my big problem with Christopher Bloomstrand, at least from my perspective, is he does have a lot of overlap between his portfolio and Berkshire. And it's hard for me to invest in someone that's investing in someone else where I could just be invested in Berkshire, and I think I would largely match the returns. So for that reason, I put him at B, but I really do think that he's very knowledgeable. I like learning from him. Now, after that, we have Chris Hohn, who I believe is at the top of his game. He invests in the monopolistic service-based companies. His strategy has been working. Like Dev Kantasari, he does deep dive analysis into every holding he has. He's not a closet indexer. He doesn't just buy the most popular companies. He holds very concentrated positions into very high-quality companies. He's someone that I'd also put up here in S tier. I think that he's differentiated. His strategy is better than most super investors, and his performance shows that. Now, next up, we have Seth Klarman, who my debate is between S tier and A tier. He's somewhere right towards the top. He focuses on an investing strategy where he really tries to look at companies as absolute value. So he doesn't look at things relatively speaking. He looks at absolute values. He does deep dive, bottom-up analysis on companies, and he's really focused on risk. So I have a high amount of overlap between the way that I look at companies and he does. But his portfolio has a lot of trading, much more trading than most of the people that I have in S tier here. I'm going to put him in A tier. I think he might be good enough to put in S tier. This one's a tough one, but I'll put him right there with A tier, which I also think is very good. Then we have Josh Tarasoff. Now he's a little bit lesser known. He's investing less money than some of these super investors, and he doesn't have any type of public interviews. So it's hard to get any type of actual content on him. But he invested in a lot of cool companies. He invested in Amazon early on. That was kind of his fame there, was investing in Amazon. He's also invested in Netflix and Spotify and a lot of these tech companies. I'm going to put him as a B tier. I think that he's very good, headed in the right direction, but he still has more to prove at this point. Now, next we have David Einhorn, who is an investor that lost a lot of money through his constantly bearish view on the market. So he's always predicting calamity and doom and gloom, and a lot of times that's not working out for him. He tries to explain why in 2019 he lost 30% while the rest of the market went up. He said nothing went right, and he's made similar gloomy predictions this year and years prior. I don't like the strategy of being a constant bear on the market. I much rather prefer investing along with investors that see a bright future, because most of the time the market goes up. So when you're constantly betting against it, I think you're going to have a difficult time. So I'll be placing him in the D tier. Now we have Daniel Loeb from Third Point. He started off strong with his fund. They had outperformance at the start, but since the past 10 years, it's really not been outperforming. So since he's had a bit of a slowdown, I'm going to put him down here in C tier. Along with Pat Dorsey, the other investors that I think are doing okay, but they're not really offering significant alpha at this point. Now, of course, we can't forget about Charlie Munger, Warren Buffett's right-hand man. I'm going to put him up here in S tier. Now, I don't think that Charlie Munger is as good as Warren Buffett, but I do believe that he offers such a wealth of knowledge for so many investors, and his track record is so good for a long period of time. He's also helped out other investors. He's not hurt them. So I think that he deserves a seat in S tier. Now, next up, we have a value investor, a super investor named Thomas Russo. He always aims for returns between 10 to 20%. So he's just aiming for that nice, attractive return there. He's had very good performance overall. He also has very low downside with his portfolio. For that reason, I put him up in A tier. I think he's very good. Now, last we have Bill Gates, who manages the Bill and Melinda Gates Foundation. A lot of capital under management. With him, I'm not going to put him as high as other investors, because Bill Gates really isn't, I don't believe, doing deep dive analysis on all of these companies. He's just preserving the amount of capital and putting it into very solid companies for the foundation. So I'm going to put him there with B tier. So there we have it, the completed tier ranking. Let me know how you think I did. Now, this also gives you a view of which type of investors that I actually pay attention to when they make changes to their portfolio, which ones I look at them for ideas and different views on different companies. For example, if Cathie Wood of ARK Innovation ETF buys or sells a company, that doesn't mean anything to me. I give it zero weighting. I don't pay attention to it at all. Just like Chamath Palihapitiya. If he shares an opinion on banks or opinion on fintech or whatever it may be, I give it zero weighting. It doesn't really carry any weight with me at all. Where these investors up here at the top, if they share strong opinions on specific companies or the market or going long or short different companies, that's something where I will pay attention to their opinion. Doesn't mean I'll always agree, but I will give it some weighting. I will consider it. So you can also look at this as an overall gauge of how much I value their opinion. But that's it for now. Hope you enjoyed. See you in the next one.